Welcome to WTF Crypto, where we peel back the layers of the onion of the crypto universe to understand what's really going on and how it affects you and your portfolio. I'm your host, Mark Lurie of Shipyard Software, and as a caveat, nothing in this podcast is legal or investing advice. Today, we're talking about bringing real-world assets on-chain with Karl Jacobs of Homecoin. Welcome, Karl. Thank you so much for joining us.
Hi, thanks so much for having me.
So, Karl, one of the things that people think about most is bringing real-world assets on to the blockchain. And this is really important for traders and crypto holders because whereas the crypto market is 1.2 trillion today, that's Bitcoin, Ethereum, and everything else, the largest market in the world is actually the mortgage market. And that's 13 trillion in the US alone, right? And there's more. The stock market, the US stock market is 95 trillion. And according to McKinsey, the total balance sheet of the entire world is 1.5 quadrillion. That's 1,500 trillion. And so the assets in the world dwarf the crypto market cap. Bringing them on chain is, an order of magnitude multiplier in the the economic activity that goes on and the economic activity that's possible to trade. And so it's really important for everyone to understand. But real world assets have been surprisingly slow in coming on chain. And I'd love to understand why. Why don't we kick off by asking you what makes you such a credible expert and guide on the subject so that the audience knows where your thoughts are coming from?
You bet. So I started building companies quite a while ago. This is my seventh one. I was at Facebook when it was six guys in a house in Palo Alto. So I have some experience in building new and different
Oh,
things.
I didn't know that you were there that summer. That's great. A few
I,
of my
I,
friends were there because I was, well, a year below him,
oh, no way.
but
That's
in
funny.
the
Yeah.
nerdy Jewish fraternity with him.
Yeah. I got a call from Sean Parker who said, you have to come meet this guy. That was literally how it started. Yeah. So, and obviously, I have a lot of experience building companies. But my journey in crypto really started about 6 years ago, and in particular with mortgage about 5 years ago. And what I was fascinated by was this idea that there's this ginormous market called mortgage that most people understand from the perspective of getting a mortgage, but very few understand from the perspective of how it's used in the world and why it's so important to the economy. Until 2008, I don't think anybody really realized what an underpinning of our core financial system mortgage had become. And that to me spelled opportunity. The problem was that opportunity was only being offered to very, very wealthy individuals or very large financial institutions like governments and banks.
Makes sense. So that leads you to start Homecoin.
Correct. The first thing we had to do in mortgage was really make it more efficient, and we close mortgages in about 24 hours at LoanSnap, which is the mortgage company that we created about 5 years ago. The problem is that we sold those mortgages to big banks and institutions because we didn't have the money in order to do that ourselves. And so we started looking around for some way that we could basically create a distributed balance sheet, in effect, allowing people to put money into a pool and have that money be used to purchase mortgages. That's how a bank works today. You put your money in an account, usually a savings account. They take that money and they lend it out to people who want to get a home. And as that person repays their mortgage, the bank takes the lion's share of that and they give you a small percentage, which is where the 0.1 or 0.2% return in your savings account comes from. We decided to flip that on its head. So basically, in the crypto world, what we can do is allow people to purchase a coin, and then the money from that coin goes to funding mortgages, and then the cash flow from people repaying those mortgages flows right back to the coin holder. This time, the people who make the most money are the people who put up the money, which are the coin holders, rather than the people who put the money into the bank accounts who get the least amount of return.
Makes sense. And just so I understand, so today, I mean, the idea of a bank, right, is that they take deposits that are on demand and then they pay an interest on it and then they lend that money out for a longer term, typically to people who buy houses for the most part, and they earn a bigger interest rate. And but it's kind of confusing to me. Like the rates you can get on a mortgage right now are a few percentage points, several percent, right? So why, if we're depositors, do we only get 0.1%? Like fundamentally, I don't understand why that is. And I think that's
Right.
important to understand what it means to go direct like you're doing.
Well, that's the problem, right? That's the problem that we saw, which is the people who are putting up the money are getting the lowest return, and the reason for that is all the people in between, right? There are so many institutions, companies, people involved in that process, and each group takes their cut. And so by the time they all take their cut, that 3% becomes quite a bit less, particularly when it comes to the bank. The bank makes about 30 times what the consumer putting money into their bank account makes on those mortgages. And that's just the way it is. Those institutions have gotten away with it for a very, very long period of time. It powers the balance sheet at the federal government level. So there's about $3 trillion worth of mortgages on the federal balance sheet. And companies and banks like Wells Fargo have over $275 billion of mortgages on their balance sheet, which effectively means everybody at Wells Fargo could quit tomorrow and they'd still be making about $8 billion a year on interest payments for mortgages. And so this is a great example of how these big, large, slow financial institutions, where there are so many people involved in these transactions, are pushing that off onto the consumer and effectively screwing over the consumer. The consumer is getting screwed in that, right? Where the blockchain allows us to go direct. So basically, your money goes directly to funding a mortgage that is someone's home, and the payments from that mortgage flow back in, and we can share that directly with the consumer at a higher percentage because we don't have all those inefficiencies in the process.
Okay. I guess before we dig into bringing them on chain, I guess I still don't fully understand, right? Like, finance is a competitive market. You would think that some banks would run more efficiently and then offer a higher interest rate to deposit holders. And then people would shift over. And so, like, banks would compete for customers. But it seems like that's not working, right? Like, why is one bank able to take 30 times more than it gives to depositors? And yet that margin is not competed away.
I think a lot of that's greed, right? And a lot of it is greed on top of greed are just these large financial institutions, rules, structures, and everything like that that have been put in place where they've built a product that's oriented toward making money for banks and financial institutions and governments versus helping out consumers, right? And this is kind of, we see this in credit cards, we see this in car loans. I mean, these were not created to benefit consumers. They're actually created in order to benefit the profit margins at banks and other places. And so people have tried. Unfortunately, until now, it took a lot of human beings to make a mortgage until we came along. It also took a lot of human beings to package up those mortgages and sell them to large financial institutions. If you look at the way that works, Fannie Mae effectively does this on a monthly basis. They package a whole bunch of mortgages together and they turn around and they sell it to others. That's a very large financial institution. And so just these institutions just haven't had the automation and the technology to be efficient enough in order to share more than what they are and get the same profit margins with the consumer. So they've tried, but unfortunately, that turns into maybe a 1% savings account. And they're razor thin on margins on those because there's so many people involved. I mean, think about your traditional bank and all the branches and brick and mortar buildings that they have. I mean, the cost structure for those institutions are massive and they have to feed that somehow.
Interesting. I guess there's probably some economies of scale. And so, in order to achieve those economies of scale, you need a big enough cost structure that you kind of need to take all that margin out. And then you're effectively competing against only a few other banks that have the same economy of scale. Uh,
That's correct. I mean, look at the size of somebody like Bank of America or Morgan Stanley, just from a human capital perspective, they're massive. And that's not counting all the people involved in those transactions, the servicers, the loan brokers, the people who are bond traders, the people who are slicing and dicing these pools and then taking a slight margin on those and selling those to other people. It's a massive industry with hundreds of thousands of people in an individual institution. I mean, when Lehman Brothers went under, that wasn't a small amount of humans that were affected. It was hundreds of thousands.
Hmm. Okay, got it. So, and today, if I want to go out and just back some mortgages myself, is that something I'm able to do? Put blockchain aside.
Blockchain is you can, and many very wealthy individuals do. But think about this: like the average mortgage in this country that the government will buy is about a $350,000 home, and so you have to be quite wealthy to be able to buy even one of those. And so imagine buying a pool of them that were somewhat diversified. That's where you're starting to talk about billions of dollars in order to be able to do that. And that's just not even remotely accessible by even wealthy people. I mean, this is
Hmm.
the ultra wealthy that are able to do this. And so what we're
But
trying to do is
presumably,
bring
there's
that.
like presumably there's some sort of pool that I can buy a share of that itself is a diversified pool of mortgages. If
You
I want
can, there are
retail
MBSs
exposure,
and
right?
there are others, but of course, then we get back to the problem of those are cut, 15 different ways. And so
Hmm.
the return you're going to get there isn't nearly the return that the wealthy individual who can buy those direct is going to
I
get. And
see.
that's the problem we're trying to solve.
Okay. Okay. I think I'm clear. So now you are trying to bring these assets on chain. So before we get to the, you know, kind of broader discussions about bringing assets on chain, I'd love to understand how you bring them on chain from a like legal, regulatory, and product perspective. Like how do you
Yeah.
actually deliver this?
Yeah, so we took a really different approach. Most of the people who've tried this before took the approach of how can we move the entire mortgage ecosystem on chain? And we just think we're a long, long way from that, both technically and legally. So we focused on how do we take the smallest piece of the real world and put that on chain and let the rest of it exist off chain as it does today so that we could basically leverage all the work that had come before us versus trying to recreate it. And that item is a lien on a home. So if you look at a mortgage is two components. It's a lien on a home, which is a promise to repay a debt, and then a agreement to repay that debt over a period of time. So this is the 30-year fixed mortgage. There's a part of it that says you owe, say, $50,000. There's another part of it that says here's your payment plan, effectively. So what we did is we took the lien part and we put that on chain. And so whenever we record a lien on a property, which is the first part of the mortgage process, then we wrap an NFT around it and we publish that to the blockchain with the address of the property, all public information that would already be held at the county. We publish that on the chain, and then we lend against that actual NFT. And so there's a lot of advantages to that. One of them being that we don't have to set any new legal precedents. The liens that have been recorded at counties, that's been happening for hundreds of years. That's something that's a widely distributed system. It's a state run system. So, from a diversification and from a distributed perspective, that is one of the few truly distributed financial institutions in the country, right? Is the recording of deeds and titles at the county level, which basically means you have this county recording that, let's say you don't trust us. Let's say you don't think that we did all those liens. You could actually go to each county and look up the lien and see that what we represented on the blockchain as an NFT is what's recorded at the county. And that's the transparency piece that I think is important about how we've built the system versus how others have built the system and said kind of, well, just trust our auditors or trust the people looking at the books. What we've done is taken that very small piece of the real world, published it onto the chain, and kept those two things in sync over time.
So just so I understand, in the lien, what does it actually say the lien holder is? Is it an entity, an LLC? Is it like a blockchain address? Like what is actually in the government document?
Yeah, so that's where things get a little complicated in the mortgage industry because there is an in between today. Uh, Today, that would be the originator of the loan and the servicer of the loan. And not to complicate things, but that's basically who created the loan and who actually collects the payments. And so the servicer and the mortgage company are generally on the lien. Usually, the person holding the loan, and in this case, the blockchain entity is backed into the originator itself. We've stayed away from LLCs because we're unsure of how those are going to be tested in the court. The courts really don't have a system for dealing with an LLC situation where maybe three of the LLC holders are just investors and one of them owns the home or lives in the home. So imagine that. So you've got four people, one person lives in the home, three people don't. And now somebody offers to buy the home. Well, the person living there, who's only one quarter of the equation, they for sure don't want to sell
Hmm.
in most cases. But the three who are investors, they might want to sell
Hmm.
tomorrow. So we're going to try to stay away from that until
Okay.
that's cleared up in the
But
courts.
so I guess I'm still confused. Like, how is the actual link between the chain and the lien established?
Yeah, so basically, we record the lien at the county, which is something we do today, and that's a normal part of operations at a mortgage company. And
Hmm.
then the difference is that we publish that information through an NFT to the chain, and that shows up on our
But
website.
what's the information that's published?
Oh, sorry, the address of the property, the size of the lien. Um, yeah, those two pieces of
I
information.
see. And then your mortgage company basically says uh, the owner of the NFT has claim over this particular lien.
That's correct. That's correct.
Okay, got it. So you're kind of holding lien and benefit for the NFT owner.
That's correct. That's well, the
Okay,
county holds it, right? Because it's recorded
sure,
at the
sure.
county, but we are the ones who keep those two things synchronized, and that's part of the service we provide to the ecosystem. Now, somebody else could do that as well, and we
Hmm.
hope that they will over time. And that's the whole idea here is that we have lots of different service providers who are today off chain come participate in this ecosystem, each providing a piece of the puzzle that we need to build a much more efficient, distributed, transparent system.
I see. Okay, got it. So, and there's a few approaches to this, right? Like you've mentioned some. So you could create at least in the US, you could create a trust and then have the trust own real world assets, and then the beneficiary of the trust is a wallet address, right? You could have a Marshall Islands LLC where, the law actually, or a Wyoming LLC where the
Right.
law actually says, the member of this LLC is a blockchain address. Um, you have your approach. Are there any other approaches? And all have their pros and cons for different types of assets, et cetera. Are there any other approaches that you're aware of to bringing off-chain assets on-chain?
Well, I think that the most common is the one you mentioned is the LLC version, where they basically take a house or an object of some kind in the real world, put it in an LLC, and then piece it apart and sell parts of it on the chain. And there's not really any precedent for that in mortgage. Splitting mortgages up into smaller pieces is just not something that's been tested. And so we're a little bit uh, pessimistic about how that gets tested in courts and whether it works out or not. The other problem is that those are not assets that there's a liquid market for in the real world. And so one of the things we focused on were what we call Fannie Mae loans. So loans that are underwritten to the standard that the government will buy the loans. And for that, you really do need the owner to be an individual, right? They shy away from, for good reason, these more corporate entities that own real world assets because of all the legal complexity.
Hmm. Okay, got it. All right, thank you for taking me through
Oh,
that.
sure.
So, um, okay, so now you have these liens on chain, they're NFTs, and you can fractionalize them, you can lend against them, you can, it sounds like in your case, you're doing a stable coin against them.
Yeah, we actually we can't fractionalize the ones we built, but yes, you're
One could,
one could. Correct,
yes.
correct. Yeah, yeah. So what we decided to do was be more traditional about it. Basically, build a pool of these so that the DAO that governs the coin basically will allow the loans to enter into the system, be purchased by the system. And then the coin that we built, there are stable coins that are built on top of dollars. There's stable coins built on like treasuries or commercial paper. Most of them today are built on a pool of unknown assets. And when I say that, I mean that they get audited, but it's a promise of someone, hey, this is what really exists. The role or approach that we took was really, hey, what could we do to make sure this is completely, fully transparent from the start? And the way that works effectively is for every dollar that goes into the coin, right? That dollar then goes into a pool of money, and then that purchases a loan that goes into a pool of loans, right? So you get a distributed group of loans. As we've talked about, you can see those loans on the blockchain. You can also know where those properties are. So you could run an analysis. So you could say, well, I want to make sure that all the properties in this pool are geographically dispersed in case, God forbid, California falls into the water, right? So I want to make sure that that's the case. And you could do that on our system. Whereas with these other stable coins, try asking what exact assets sit in those bank accounts, and you're going to get an answer that you don't like, which is, well, just trust us that it's there. The other part is that those assets themselves are centralized. The fact that they exist in a bank account or through a banking relationship, we think makes other stable coins somewhat difficult. And we're seeing some of that happen right now is, the concern around DAI and its backing by USDC is, well, that's a centralized coin. It is centralized into these bank accounts. And our goal is to build a completely decentralized system so that no bank would be involved either in the creation of the assets or the holding of the assets, the servicing of the assets, or even the payments. And in fact, we have two of our loans where their mortgage payments are made from their crypto wallet. So the banking system is not involved in any of the repayments of those loans, which means if the whole banking system went under, those people would still be repaying their home loans.
I see. Okay, got it. So you have basically what you've done is productize this in the form of a stable coin, and the difference between your stable coin and
Correct.
home coin and a USDC or USDT is that USDC and USDT are taking the money like people deposit, and they are putting it in money markets, or really they're like probably a lot of it's just going into mortgages, right? And but you don't really know.
Way
It's
far
just
down the road. Yes,
way
exactly.
far down the road, yeah. And so you don't really know what that is, right? Like
Right.
you see a pie chart with this much is allocated to mortgages, and then you see an auditor's report saying this is true. Or in the
Right.
case of Tether, you don't really even see the auditor's report. Okay.
Right.
So whereas you're saying, well, actually, like in our case, is backed by essentially similar assets, but the assets themselves have been brought on chain. You can take this pie chart and you can slice it all the way into the individual houses that are backing this thing. Um,
That's right. I think if you remember the movie The Big Short, one of the things that he did was dig in to find out what was actually behind these credit ratings and what houses were actually there. And he was quite surprised by what he found, as we all know. And that's why he shorted the mortgage market. That would be something you could do right now today on top of our existing system. You could do that analysis and you could decide, well, I don't like the fact that too many houses are in Texas, for instance. And I think that's where this radical full transparency needs to happen. A lot of these stable coins were built at a time when crypto was nascent. And having a stable coin was a huge benefit. And a bank account was like, well, okay, that we're willing to give that up. We're willing to give up a little bit of the crypto ethos in order to have some of the stability that a stable coins brought. Now it's $1 trillion market and growing. And now we want to move real assets and real money onto the chain. And I think that we're going to have to take kind of a stable coin 2.0 approach. Like, what would we do if we, learn from our past and created something focused on the future? And I think that's something where it's fully transparent, it's distributed, and in many ways, it's one of those things that the average person can look at it and say, okay, I can go see what's backing this coin. I don't have to have somebody tell me. It's not an auditor. It's not a bank. It's not a government. It's I can actually do my own homework,
mhm,
which I think is an important part of the
got it.
crypto ethos.
And so what happens with the cash flows, right? Because that's a yield bearing asset. In the case of USDC, USDT, those companies just keep the interest, right? That's their business model. How does it work for you guys? And that's
Yep.
fine, right? Like they need to pay their bills. But I'm just curious, like when you bring these assets on chain, are you also bring the cash flows on chain? And then how does that, there's a whole regulatory problem there.
Right. So that's actually one of the great things about the protocol, right? Is that the protocol is designed to share that money with the people involved in the process. So it will share some of it with the protocol itself. We have to pay our bills too, right? A lot more efficiently than others, but we still have to pay them. The other is the people involved in creating the loan and servicing the loan. And so that's today. The idea for that is like they send the bills out, and they make sure that people pay on time and things like that. And then of course the lion's share of it goes to the coin holders, the people who provided the capital. One of the rules in capitalism, the unwritten rules, is if you provide the capital, you make most of the money. But in fact, the banks and others have been taking advantage of consumers and flipping that script on them. This system allows us to do it the right way. So the cash flows basically flow directly to the servicer, and there can be many servicers. We're one. We'll hopefully have thousands of them in the future, and then that money flows onto the chain, right? So it flows basically in through the system, sometimes directly out of a wallet, which I think is where things are going in the long run. But not everybody has the ability to pay their loans in crypto, and so for those who don't, there has to be a fiat conversion system, and that has to be again distributed and transparent. And then you can see those payments flowing back into the pool and then being distributed out to the coin holders based on how
I
much
see.
of the coin they
Okay.
hold.
I see. So, and this is what makes it decentralized because
Right.
the distribution of these cash flows is decentralized. It makes it not a security.
Exactly. There's kind of two key things. One, mortgages themselves aren't securities, which they're state
Oh,
regulated, and have
I
not
did
been
not know
securities.
that.
Yeah, yeah. It's one of the interesting things that we learned in the process is that because they're state regulated, and it's been tested actually at the federal level. The federal government tried to nationalize mortgage a long time ago, and the states, of course, rejected that. I think for good reason. It's one of the first and only truly decentralized asset systems in the country. The other is the Howey test. And mortgages are unique in that sense because we can't do anything to make those mortgages more or less valuable. We can't make the borrower pay more money per month. We can't make improvements on the house. We can't control anything that it comes to. That's all regulated by the state and the federal government. And so the asset class itself passes the Howey test because we can't do work to make it more valuable, which by
Interesting.
definition, the Howey test, it passes.
Yeah. Super interesting. Okay. And that's interesting because that is you know an issue that a lot of real world assets are going to have coming on chain is how do you deal with the cash flows? How do you deal with the Howey test?
That's right. That's right.
Okay, so I think this is all. Well, sorry, go on.
Well, no, I think that's where you get into interesting things around asset classes that investors are involved in, because they're involved in those asset classes for a reason, and by definition, and they're trying to improve the asset. So, for
Hmm.
instance, if you're splitting up a house in Aspen and the owner puts a solar roof on it, well, that's improving the asset, and
Hmm.
so that's a different story than what we have.
Yeah. Okay. All right. So I think I understand now. I guess the next question is like, how's it going? Do you think there's real? How do you feel like demand is going for these real world assets on chain?
It's going really well. I think the recent issues around stablecoins have kind of accelerated a trend we were already seeing. So there's kind of two things that we had started to see. We launched the project just late last year, so it's a little bit young, but we already have 35 houses that we've financed with the system. And I think the two things that we started to see were a tendency toward wanting durable yield. And we haven't talked about that, but one of the most important things to think about today is not how much yield you're getting tomorrow or how much yield you're getting even next week. How much yield are you going to get over the next 5 to 10 to 15 to 30 years? And we got a little confused in crypto. We saw 30% rates and we thought, oh my gosh, that's fantastic. Because in our head, we think that's got to keep going. But that wasn't the case, as we clearly found out. In fact, it didn't just go from 30% to zero return. The underlying assets basically evaporated. And so, that's something that consumers just have never been confronted with. And so our goal was, hey, well, how do we create a durable return asset? And then how do we get people to think a little bit differently about how they're investing? And today, getting a 30% return is great, but eventually you're going to want to find a place to put, say, 10 to 20% of your money that is going to be there and is going to give you, say, a 5% return, but over a much longer period of time, which any investor knows is highly valuable. 5% return over 2 years is worth, a lot of 30% returns over 2 weeks. And so that shift had started to happen, and then the crypto crash happened. And now I think everybody's waking up the next morning from a pretty big night and saying, "Gosh, had I had my money in something that was effectively backed by a real world asset and off chain and cash flows from that off chain asset, then I would have been be doing a lot better than I am right now." So that has caused a lot of interest, not just from individuals, but institutions who look at their crypto holdings and say, "Gosh, maybe we should have had some of our treasury or some of our investments in something that was truly stable, truly transparent, and a durable return, a return
So
over time."
that makes sense, but that doesn't sound very much like the crypto zeitgeist, right? Like it doesn't strike me that there's a lot of interest in crypto for uh, good common sense, conservative, but good returns. Um, and instead, it's like, hey, if we're not getting 30%, it's not worth our time.
Yeah, and we
And
got a lot of that last year,
yeah,
particularly. That has cooled down for sure.
yeah,
So
but
as
and
people,
it seems to me like that's probably one of the reasons why more real world assets haven't come on chain, right? It is once they come on chain, the crypto space multiplies by orders of magnitude. But there's no interest in trading them, so they don't come on chain that much right now, right? I mean, there is like you are generating this interest now, right? But the order of magnitude, and this is the stage of your project, but the order of magnitude, right? It's not like 20% of all crypto is in real world assets,
right,
right? Or in reasonably returning assets, right? It's a small portion total, not just mortgages, all real world assets. And I wonder when you think that this goes from like 2% to 20% and how.
yeah, I mean, I think just looking back in history, we've seen this movie before, right? We saw a huge run up in the stock market really early on, with very little. There effectively were no bonds. There were no mortgages in the system. Very few, I would say. Um, and then we had a big crash, right? And then we had a depression, and an entire generation changed their thinking on what a investment really was. And so you saw all these people who basically lost everything in the stock market kind of rebuilding their lives and thinking, okay, this time I'm going to do it a little bit differently. If I do get some wealth from that 30% return you're talking about, I'm going to take some of it, I'm going to take it off the table. It's like being in Vegas, right? So take some money off the table if you win and hold it, and then play with the house's money. And I think that ethos powered an entire generation. We saw the same thing happen in the 99 crash. All those people who invested in internet stocks who did quite well and didn't put some of it away, many of them lost everything. And a great example of that is Mark Cuban. So Mark Cuban, when he sold his company to broadcast.com to Yahoo, he made a tremendous amount of money by actually shorting Yahoo stock. So he sold his company, and as a safety net, he basically shorted Yahoo stock just to make sure that if the stock went down, he made money and didn't lose everything by selling the company for stock. And sure enough, Yahoo went from whatever it was, a couple hundred down to 20 or whatever the meteoric decline was. And a lot of the money that Mark made was from that exact trade. And that's somebody who's been through it before, who has the experience. And so we're just nascent in crypto. It's just we got a lot of new investors, a lot of people who haven't been through a downturn, as we all know. And we saw, what happened, just a few months ago. And now a lot of people are waking up from that and saying, okay, how am I going to not let that happen again? And so each generation, it seems like, has one of these highly impactful events that changes the way they think about investment and return. And it sounds great to be able to put your money into Tether, right? And go do Anchor and get 30% return, until you don't get that, and then you lose your principal, and then you think differently about investing. And that shift is underway, and we're hoping to be there to be not only helping investors, but helping the ecosystem itself, right? The ecosystem needs stabilization, just like the stock market did before, and just like, at the end of the day, the financial markets worldwide did after 2008.
Mm. So so first I agree with you, and I think I agree. It's just a matter of time, right? It's like obviously, as the market matures and people go through these cycles, they are going to want to access other assets and real world assets. Um, do you mind if I play devil's advocate and stress test this
100%.
a bit? Okay,
Yeah,
because
you
I'm
bet.
really curious your replies. Um, I think one counter is there's such a secular trend of value creation in crypto that the cost of capital, even aside from like crazy Ponzi yields, is high enough that it will consistently dwarf real world yields for a long time, 10, 20 years even, right? I mean, DeFi, gaming, NFTs, there's like all these secular trends where like there's markets are being created uh, and in crypto. And so like what's the cost of capital in crypto? Well, it can't be 30, 40% reliably, but could it be like 10% reliably or 8% reliably? Like, yeah, I think that makes sense. Like I think the GDP of crypto is probably growing at 10% a year on average for the next 10 years at least. And so if the GDP of the real world is growing at 2% a year, then bringing off-chain assets en masse onto the on chain like is not going to attract interest and capital. And that seems like a structural departure from, you know, tech or the, you know, Black Tuesday or Black Friday, whichever it was in the 30s, where people shifted to more conservative investments.
Yeah, I think that's a good thought experiment. And I would say there are a couple things to provide context. The first is all startups, and I would call the blockchain and crypto a startup, just like the internet was, um, are going to have stunning growth. But that doesn't mean they get to break the rules in the long run, right? Because eventually they run into what my friend calls the law of big numbers. And you saw it in internet stocks. You saw it when the stock market was running back in the 20s and 30s, and you're going to see it again. And so every new technology, every new invention has unlimited potential in the early days because they're so small, right? I mean, $1 trillion. It's not even. It's a tiny fraction of even just the mortgage industry, right? And even smaller of the worldwide, as you pointed out. And so I don't know what it will be, right? But it won't be those kind of returns over 10 to 20 years. And why can I say that? Well, history is, as they say, it basically doesn't repeat, but boy, it sure does rhyme. And it's going to rhyme in this case, I think, because of what we just saw, right? What we just saw was a massive destruction of wealth for a group of people who didn't necessarily understand the financial product they were investing in, right? And so there's two outcomes of that. One is we're going to be more open and honest and explicit about these products. We're not going to sell credit cards that are 30% interest rate and pretend that they're really 10, right? Which is what was happening in the credit card industry. And I think that's going to cause consumers to be more realistic about the return. You're seeing returns in crypto plunge, right? I mean, you look at a lot of these coins that were returning 10, 20%. Now they're much more like 4 to 5%. Unfortunately, that's not a durable return. We still don't have any idea how long those returns are going to last. And we don't have the transparency to tell like we do with Homecoin. So I think that's one. I think the other is that it's not an either or, it's an and. If you look at modern, even reasonable wealth management, part of wealth is gaining it, the big hit, the big contract. If you're an athlete, the big contract you signed, or a musician. If you're a trader, it's that three or four, or selling your company or whatever it might be as an entrepreneur. But wealth preservation is the other side of that. And we have a whole group of people who are not thinking anything about wealth preservation until now. And it's one thing to say, I don't care. I'm just going to, hodl, and I'll bet on Dogecoin forever when you're down 10%. When you're down 70% and you have to start over again, or you have to start from zero, that's a very different thing. And I think that's the change we're starting to see as we broaden the group of people that are coming to crypto. And I think if we don't become a reasonable wealth management platform for people and have all those choices, all the way from super crazy magic internet money all the way to what I would consider an analog to the conservative investing in mortgages or bonds or treasuries. I don't think we're going to have a ecosystem that will attract the large numbers of people that we need to power those gains over the 10 to 20 years that you're talking about. I think it's just going to have to become more balanced.
Okay, makes sense. Uh, I see. So the market cost of capital, let's say it's 10% in crypto, that's GDP growth. It's really like a blend. What it really is there's like some 30% cost of capital and there's like some 2% cost of capital. And humans have net fear or loss aversion, right? And so they're going to have a properly diversified portfolio. And so the more wealth that gets generated, the more some of that will rotate into, shall we say, conservative assets.
Exactly. And it's I think and when people start thinking about wealth preservation, not just about wealth creation, and that tends to happen as people gain more experience in the market. That also tends to happen when people lose money. I mean, it's all great when all boats are rising. I remember a friend of mine. His analogy was, if he heard a stock tip in a cab or in an Uber, that was the moment at which he was going to sell.
Yep,
so,
makes sense.
uh, and I
I mean,
certainly
I
heard a
guess.
lot of crypto tips in Ubers over the last
Yeah, yeah,
couple of
I
years.
really did. It was remarkable. Yeah, I mean, I guess there's diminishing marginal utility to having more and more money as an individual. There's also increasing marginal uh, disutility in losing more and more money.
That's correct. And we talked to a lot of people late last year, early this year, about putting money into home coin. Particularly, people are trying to measure or basically measure and grow their treasury. And we got the same answer. I can't get the same returns. Why would I talk to you? And boy, are those people calling back and interested now in preparing for what's coming next. Because the problem that people don't realize is that you've got to start now if you want to build up those stores of cash flows. I mean, what is everybody talking about now in a recession? How do I get cash flow? Right? Well, I'm going to buy a property, I'm going to start a business, I'm going to do whatever. Or you can buy home coin, right? Which is cash flow from houses that are actually rising in return in this environment. And so people who've been through a recession, which is very few people in the current market, think like that. They're like, I need to have some kind of cash flow. And that's not really accessible to your average coin holder or your average crypto person. If they've got, say, $2,000 a year to put into the market, they're not going to be starting their own business anytime soon. Right. And so the ability for them to participate efficiently in that ecosystem and get that 4 to 5% durable return, and as well make the crazy bets on Dogecoin or whatever wacky new coin that's coming out soon. That I think is a more balanced approach to it. It may be a little bit slower, but you're not going to lose everything, which is kind of what we're trying to prevent from happening that happened in the past few months.
Why doesn't that capital rotate out of crypto and into assets, real world assets, through the traditional financial system, right? I mean, I get that there's a convenience, right? If it's available on, if you have money, you want to diversify on chain,
Right.
and
Right.
the option exists on chain, then sure, do it. And it also sounds like you're bringing some efficiencies to the process of lending. So okay, that's
Right.
great too. But in terms of bringing off-chain assets writ large on chain, why is there anything stopping this capital from going off chain? Is it then there's a tax hit because pulling capital off chain essentially like makes it much more likely that someone will file taxes on that?
I think that's a large part of it. I think the other is just, as my friend said, hey, that's meat space, and I don't deal with meat space. I think it's just an ethos thing. It's like I don't want to touch anything that is off chain without a wrapper around it that's on chain, right? And so that's one of the reasons we created Homecoin. We heard that a lot. Like, I would love to invest in a pool of mortgages. I would love to have that safety of a asset that is not correlated to crypto. right? That actually rises in return in a recession or an inflationary environment, not decreases. And but I'm not willing to go off chain to do that. I'm not willing to liquidate, my ETH portfolio or whatever it might be, move it into a fiat account, and then even worse, I lose all the efficiencies that brought me to the blockchain in the first place. And I think that's one of the things that we've noticed is, and one of the reasons we built a stable coin. I mean, our stable coin is pretty unique in the sense that you can hold our stable coin and get a 1% return. There's not a stable coin on the planet that'll do that. There's not a bank account on the planet that will do that, right? And so that's the power of crypto and the blockchain. And then the other is being able to lock up over a certain period of time your money and get a even higher return. And that's again something you can't fluidly move your money in the existing off-chain world or on-chain world and gain higher return based on how long you're willing to commit the money without a lot of work, a lot of paper sign, funds, getting a wealth manager, all that stuff. And that's not just a pain, that's just inaccessible for most people who are crypto holders.
Makes sense. Okay. So here's my takeaway from our conversation. Tell me if you think this is a good takeaway. Uh,
Okay.
the story of off chain assets coming on chain is likely as follows. Um, wealth, generational wealth is created for people who are deep in crypto because of the appreciation of Bitcoin, Ethereum, a bunch of other stuff. That wealth wants to diversify and wants to stay on chain because of who they are. That pulls real world assets on chain to serve them,
Right.
right? Over time, enough of that happens that it kind of makes sense for non-crypto people to also begin trading these things, these real world assets on chain, because there actually are efficiencies there.
That's right.
And then over the long run, we're actually, trading and using all these off-chain assets on the blockchain as much or eventually perhaps more than the traditional rails.
Yeah,
Um,
exactly. And then we start to solve this problem by moving more and more of these pieces of infrastructure on chain. And I would say I love the way you summarize it. I think generational wealth is kind of a funny concept. What I would say is there's wealth, and it doesn't become generational unless it's preserved. And if you're the one creating the wealth, you have a responsibility to preserve that wealth and not have your children or your children's children wake up one day and find out that all the money was in the next tether or the next thing that should have returned 30% but didn't. And that's, I think, where you see a big difference between wealth, creation and generational wealth,
mm,
which in order to have that, you have to preserve it and you have to use all the tools available to you,
including Homecoin. Awesome.
including Bitcoin.
Karl, thank you so much for joining us today. This was really interesting. I learned a lot. Um,
Right.
is there anything else you'd like to share with our audience, and in particular, how they can follow you or learn more?
I'm at Karl on Twitter, so that's easy, at KARL. Homecoin.finance is the website to find out more about our product, or on Twitter, we're at Homecoin Finance. Come join our Discord, come have a conversation, ask great questions like you did today, and learn more about investing in an asset that is stable, durable, and fully transparent, so you know what you're putting your money into.
Awesome. Thank you again. We really appreciate it.
Great. Thank you.